Welcome to the 3-Edge Weekend Review for the week of March 10th. I'm Fritz Folts, the Chief Investment Strategist here at 3-Edge, and joining me here once again today is Steve Cucchiaro, the CEO and Chief Investment Officer here at 3-Edge Asset Management. This week, Steve and I will discuss some of the key factors behind the recent downturn in the U.S. equity markets and what might be in store for the economy and the markets in the months ahead. Importantly, we'll discuss what course of action may be appropriate for investors to consider going forward, and whether it's time for investors to begin to play more defense in their portfolios. So let's get started. So here we are, mid-March, and the U.S. equity markets have experienced a material decline since reaching record highs during the third week of February. By Thursday of this past week, the S&P had declined by 10% since February 19th, thereby entering into correction territory, while the Nasdaq had declined by approximately 12%. Importantly, both the S&P and the Nasdaq have now fallen below their 200-day moving averages for the first time in years. And the 200-day moving average is simply a popular technical market indicator used by investors and traders to help identify longer-term price trends for either individual stocks or equity indices such as the S&P 500. So when a stock's price or the price of an index is trading above its 200-day moving average, it's considered to be in an uptrend, and when it is below the 200-day moving average, it is considered to be in a downtrend. Meanwhile, this past week, the price of gold reached $3,000 an ounce for the first time ever, driven by uncertainty over the Trump administration's tariff policies and from buying by central banks. On Friday, markets got a bit of a reprieve when it appeared that the Senate was poised to vote in favor of a 6-month continuing budget resolution, which would avoid a government shutdown. So, Steve, this past week, both the Nasdaq and the S&P reached correction territory, having declined by over 10% since their highs in February. And I can tell you that talking with financial advisors and investors, they're very anxious about what is going on in the world. And frankly, they aren't sure what to do, if anything. So perhaps you could just get us started by describing the current environment and pointing out what factors have contributed to the recent decline in U.S. equities during the past 4 weeks.
Well, Fritz, I can think of a few, and coinciding with the peak of the market turning into the beginning of this correction was the loss of the so-called Trump put. There was a lot of complacency by investors in the market that they never had to worry, because whenever the market ticked down, the president would come with a tweet or a statement or a policy to keep the market going upward. And that was what he's done in the past. And all of a sudden, a major departure, he started to talk down the stock market, that it wasn't so important. So that was one. Second, you alluded to, is the radical uncertainty that's been caused by rapid-fire policy changes by the administration. And what that's doing is that CEOs of corporations are now hesitant with their capital investment plans. So they're hesitant to go forward, knowing that the future is more uncertain than they thought. They're hesitant to continue to hire, because the future is more uncertain. Third is the threat of stagflation. And you mentioned tariffs. Bad case scenario is that the tariffs make prices go up because you're paying a tax. Consumers would pay a tax to buy those goods. And at the same time, the economy could slow down because the tariff policies turn into a trade war. Fourth is that there's a wealth effect that's getting hit by this correction. And so much, in an unusual way, more of the consumer spending has been done by the highest levels of wealth, more than normal. And now, even at the highest levels of wealth, they're pulling back their spending because no longer can they rely on stock market gains. They're worried about this correction. And then finally, we have rising credit spreads. The yields that lower quality corporations are having to pay to borrow money are rising in relation to safer yields. And that is often an early warning of recession. So that's another factor.
All right. So let's dig in this a little deeper then. So do we just need some clarity or, around the tariffs, or are we seeing the end of the American exceptionalism trade? What are some of the potential scenarios that could actually play out in the months ahead?
Well, I would say that the biggest negative surprise to many investors is that there's a hope that tariffs were only going to be a negotiating tool, and that the idea of tax cuts and deregulation would happen first and take precedence, and we might not even hear about tariffs till further down the road. Well, that just didn't happen. The opposite happened, and so now we are disrupting corporate plans, and the tariff policies are not being taken lightly. They're being met with retaliation.
Yeah.
So this is similar to what happened in 1930. The most similar tariff activity to what's going on now happened in 1930 when Congress passed the Smoot-Hawley Act. And that turned out to be a disaster. And many credit the tariff policy then turning a recession into the Great Depression. So for some reason, we seem to be following down that same path. Now, despite the tariffs backfiring, I think there's still time if the strategy changes and focuses more on positive factors and less on tariffs. But so far, the administration seems to be doubling down when there's retaliation or more tariff talk. And that's scaring investors, it's scaring corporations. So just as a rising tide can lift all boats, a falling tide can harm the global economy and all the participants.
Right. And yeah, I think you had mentioned this to me earlier in the week, that in game theory, if you're playing a zero-sum game, but the other side is actually retaliating, you're not going to necessarily win that game. So
it's a lose-lose
very interesting.
Instead of a win.
Yeah, exactly. All right. So my final question, as always, centers around, what might investors consider doing in their portfolios now? So we've seen this decline, the pullback in the equity markets. And for this question, I'll refer to this commentary that we have done and now recently revised, calling Investing Defense Can Win Championships. And there's actually a link to the commentary in the notes of the YouTube video. But in the spirit of the commentary, is it time now for investors to play defense, or should they just buy the dip?
Well, Fritz, to be fair, most corrections are short-lived, and they do bounce back fairly quickly. But there are exceptions. And the exceptions, history shows the exceptions are when the starting point of the market correction is when the market is in extremely overvalued territory. Then all bets are off with a rapid recovery. So the way we measure valuation, and we do this in a very comprehensive way, is that this correction started when the market was in extremely overvalued territory, on a par with the two most overvalued markets in the last century. One was summer 1929. The other was early 2000. We had the Roaring '20s bubble burst in the 1930s. We had the tech stock bubble burst in the year 2000 and 2002. And now we have another such period where the market is extremely overvalued, by some measures, even more overvalued than those two conditions. So I do think that while most corrections provide opportunity for a bounce back and to buy the dip, that we can't ignore the risk that this could be more serious than a normal correction. So we believe, I believe, you believe, that it is time to play defense. And I have to say, for our audience, I think your paper on the rationale and the approach for investors to play defense is excellent. And it doesn't say we stop playing offense as well, but it's so important to complement that with playing defense. So one way to tell if this is just a great buy the dip opportunity or the beginning of a more serious correction in bear market is that if the rallies that happen from now on climb beyond the previous peaks and hold, then that's a sign, like we've seen over the last several months, that this bubble is not ready to burst. On the other hand, what we've been seeing in this most recent correction is that the rallies make a lower high and the dips make a lower low. And that's a telltale sign that this could be the beginning of a true bear market. And so we believe that the rallies could be best used to enact some of those defensive policies. Now, we talked about the threat of stagflation. As an example, we think that it's a mistake to have an overly high exposure to equities based on your own risk profile. And we think that in the big rally in the stock market bubble that we've had over the last 2 years, people got over their skis and took on more equities than was appropriate for their own personal risk profile. So now's the time to lighten up and get back to a more reasonable equity allocation and use the rallies to do that. And then also, there are instruments that can best hedge against stagflation. Gold is one of them. Gold is an excellent hedge against stagflation. TIPS, Treasury Inflation Protected Securities, are designed to be an excellent hedge against stagflation. And then shorter-term treasuries, which can be safe and used as dry powder, take advantage of lower prices if, in fact, we do get into a more serious bear market.
Excellent. So play defense and use more than just stocks and bonds to do that.
Exactly.
Excellent. Thank you. Thank you very much for that. So that will do it for Steve and me for this week. As a reminder, all our videos are always available on our 3Edge YouTube channel. As I mentioned earlier, there will be a link to this video in the notes section of our YouTube page. And additionally, you'll find the commentary on our website. And the website is 3edgeam.com. So until next time, on behalf of Steve and everyone here at 3Edge, thanks for listening.